Hello, everyone. We made it through elections. Wall Street and Main Street are still having very different experiences, and markets continue to defy the pandemic. We'll cover that and more in today's Quarterly Context webinar. Welcome to our webinar for the fourth quarter of 2020 for the clients and friends of the advisory group. I'm Greg Patterson, CEO. For those of you not familiar with the advisor group, we are a wealth and life strategy firm focused on helping business owners and leaders with their financial goals in their multiple realms: the personal family realm, their fiduciary retirement plan support efforts, as well as their communities through foundations and endowment support. To complement the strategic work we do for clients, our Quarterly Context webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help people both in the personal wealth and institutional client space to stay more relaxed by being informed and make better decisions towards your goals. The first section is mostly high-level. Section 2 has more charts and details for those interested. Try to keep the first section to about 15 or 20 minutes. And then we'll also circulate a video link should you like to view some part of it again or pass it on to someone you think we can help like we've helped you. And if you have any questions, please submit them to the question box and we'll either answer them as we go along or at the end. As always, I'd like to remind ourselves and everyone of focusing on what really matters and that you can control in the middle of that Venn diagram there. And this 4-quadrant box is always, this goal discovery chalkboard is a helpful way to think about that and the timing of things in terms of short-term versus long-term, what's desired versus required. And so it's a good exercise every once in a while to scribble that out or print this out and jot those things down, whether regardless of whether it's a personal or fiduciary situation. As always, news have some impact on the markets, but when we put it into the longer perspective, things look a little bit less drastic. And as you can see, some of the news in the last quarter, during the fourth quarter and year, and maybe the most notable recent effects are the change in the White House, and something that got less attention was the Brexit trade deal, which, while finalized internally within the UK quite some time back, actually reached the final deal between the UK and the EU. But what once seemed like a very big deal a while back turned out to not have had a major impact on markets, and the same could go for the election. There are a lot of concerns that the election could, concerns about the election process, how people responded, could lead to some destabilizing effect for markets, but that turned out not to be the case, as is usually the case in elections. In terms of markets, again, another very strong quarter, really stronger than it should be at some level, with stock markets in the 15 to 20% range and bond markets hovering just below 1% for the quarter, which is still above the full year expected return. For the year, the US market up 21%. That's including the COVID, the big COVID drop in the beginning part of the year. Emerging markets also up fairly strong. International looking more like the projected annualized return that we sometimes talk about yearly, and so that actually is a normal return, whereas the other returns are less normal. In terms of a few economic tidbits, the GDP was estimated for Q4 at 2.8%, and the 2020 overall estimate turned out to be down 3.6%. That was after the second quarter being down 31.4% and Q3 being up 33%, with a September year-over-year change of negative 2.8 or almost 3%. And China turned out to be the only country with positive GDP during the year. Rates in terms of the Fed remain unchanged at rock bottom levels, 0 to 0.25% range. And the Fed is projecting that there won't be any changes until after 2022. They continue also to stimulate the economy in addition to those low rates through the purchasing of treasuries and mortgages. And there's no clear end in sight for that stimulation program. Inflation remained pretty low. In fact, down to 1.2%, lower than the Fed's target level. And that doesn't mean inflation will never happen. However, there are growing concerns that all of the stimulation will finally lead to a boost in inflation. And if that happens when the economy starts cooling, that could lead to, in theory, a period of stagflation, which we have not seen in a while. Unemployment numbers are still significant, hovering just below 7%, peaked at just under 15% in April. And still only 12 million of the 22 million jobs lost have been brought back. So somewhat surprisingly, in the last quarter, consumer confidence was up slightly, but still not at normal levels. And a few miscellaneous elements for the market. Markets viewed the Biden presidential win positively, maybe viewing it as a stability factor. And of course, there's expected additional stimulation if it can make it through Congress. And another note that the S&P is up 70% since the bottom of that COVID drop, which is just an enormous number and defying again the pandemic. And then a political note, just because it's such a unique moment, we have made history with the first woman vice president. And that is something that I think we can all celebrate, expanding the tent in terms of who the leadership set now includes. And for someone with daughters, that's even more exciting. Regardless of political party, that's exciting to be able to have your daughters grow up in a world where that feels like a possibility. This is the time of year we take a look back at the very long term in terms of range of returns. And if we look back over 230 years, you can see how they stack up here in terms of different return buckets, with the bulk of returns being in the 0 to 10% range. The next highest is in the 10 to 20% range, and those returns lean towards the lower end of that range when you actually look at them. But then still a pretty sizable chunk in the 20 to 30% range, and then a bunch that are also in negative 10, negative 20, negative 30, and a few that are way above. But some of those really high annual returns have not happened in quite a while if you look at the actual dates here. But still, if you look at the last 10 years, 14% 10-year return. That's almost twice the expected returns. And the implications for that are that there's eventually reversion to the mean. Markets tend to cool and go back to the averages. And for them to go back to the average, they might have to be below average for a while. So no one is specifically predicting how and when that might happen, but that should not be a surprise to anyone if it does over the next 10-year period or so. Just reinforces the importance of planning and proper saving strategic design. In terms of the 4 bad bears chart, you can see the COVID market still tacked on here to the global financial crisis market. And the big drop, the very rapid rise, and now seems to be bouncing back and forth roughly within a range. If we look at the low rates referenced a few minutes ago, you can see a chart here going back to the 1950s where the average rate is considerably higher than what it is currently. It's hard to have an average close to 0, but right now over the last 10 years, with the exception of a ratcheting up for the last couple of years until it pulled back down again in the COVID period, it has been hovering right around zero. That is highly unusual, highly stimulative, and has complications both for bonds and for whenever the next significant downturn is, even though we're in one now. Without that, some of that dry powder of being able to lower rates, the Fed can't do as much as they could if rates were higher. And when rates go up, that has a negative impact on bonds, and we'll see some of the expected return implications for that shortly. If we look at the yield curve, shifted up just slightly in the last quarter, and has a relatively normal shape. But the notable thing here is that the bond market through the yield curve really is sharing its opinion about the future. And when you've normally, after and during a significant recession, the yield curve would shift up materially higher, sort of looking out farther and expecting that the economy will be doing better on the horizon. But what's being shown here is that it's hovering at this low level, which implies lower growth expectations over the next number of years. If we look at the coronavirus status, these dotted lines reflect the last quarterly context meeting dates approximately. And you can see it appears that we have meetings oftentimes when there's a temporary peak. So maybe we should stop having these quarterly context webinars. You can see, got ramped up a little bit here. Some initial peak, especially in the US. People hoped that was the end of it. Nowhere near the end of it. You can see it really ramped up here and globally as well. There is some talk of whether or not maybe we have truly hit the peak, but others would say that it's far too premature given some of the aggressive variant strains that are now making its way across the world and across the US. And these heat maps really are tell you a lot about where things are currently more significant, more problematic, and pretty amazing to think that the US has about 20 to 25% of the cases and deaths, but only 5% of the world's population. That's not how it's supposed to work here. In California, you can see a lot of the problems currently are in Southern California, and there have been heavier restrictions and some very problematic, apparently, ambulance waiting lines outside of hospitals because they just don't have enough beds in some areas. Hopefully that will improve soon. So all of this points to a number of unusual dynamics. COVID continues. Main Street, the average person is struggling versus those that have heavy exposure to Wall Street, and with the stock market doing so well. And even within Wall Street, there's, while it's a little more variable now, there's as mentioned, particularly in the last webinar, the FANGM stocks, the big tech stocks, that's an acronym, by the way, Facebook, Amazon, et cetera, have really done much better during COVID than others. So there's a number of different levels of things going on here. Unemployment remains high. Those numbers have picked up and have continued to hover at higher levels than expected. However, interestingly, there are fewer bad loans than expected. So there's some good news out there, which offsets some concerns. What some might find interesting is to think that some of the characteristics and the things that are happening in the country now are actually more characteristic of a less developed country. And that has implications in the medium and long run, especially if the middle class continues to shrink and if disposable income and wages shrink or don't keep up with inflation over time, because that middle class is really the spending class and is oftentimes the core of the economic engine. And of course, there are a number of other non-economic factors that are very important as well. Government debt grew by $7 trillion in the last 4 years. And that brings us to almost 22 trillion. So those are some big numbers. Now, the one good news about that is that rates are so low that it's easier for the government to pay that back, assuming that there's sufficient tax income to not present a risk to that, and so forth. But as mentioned, stock markets continue to be really surprisingly resilient, partly because rates are so low and really stimulating risk-taking and business growth, and another 900 billion plus package announced recently. A number of factors there that are kind of propping up the market. Some would say a little bit artificially, and that artificially really depends on how things play out and whether we thread the needle in terms of a number of factors. Janet Yellen, who appears will be the new Treasury Secretary, is a proponent of big spending while rates are low, with the idea that would be critical to avoid a deeper recession. So that's an interesting stance, and to the extent that plays out, will have an impact on markets as well. And then economists in general expect things to kind of be weak through next year, and then potentially get a little better. And a number believe that we'll be at more normal growth rates, maybe not fully recovering all of the past losses, but back to a more normal level. So some recovery in the middle of 2023, but of course, time will tell. A couple notes that may be helpful for those of you that are 401k fiduciaries or have kids who are, or others that you care about, where you want to encourage them to make good decisions. There's some research that suggests, and this is not just at the 401k level, but there are other studies and anecdotal experience of our own with personal wealth clients, that those that have some emergency savings tend to sleep better and make better decisions and feel less concerned when the markets are wobbly, and therefore less likely to pull out of their 401k or go into panic mode regarding markets. And while it's tough to imagine doing this right now, fiduciaries in the future might be best encouraged to at least bring up the idea of an automatic savings account that people could set aside a little something gradually and build up their own emergency account to help have a little cushion for difficult times outside of the 401k. And an interesting comment here, sort of on that note, you don't rise to the level of your goals, you fall to the level of your systems. And this is why it's so important, especially for 401k fiduciaries, to help people systematically make better decisions with the investment design, automatic savings, and so forth. And 50% of plans now use automatic enrollment. And so if you are not, that's something worth considering, because people can always opt out. And it turns out when in surveys that ask people if they are in favor of it, the very few people that are not actually think it's a good idea for other people. So it's less of a concern than fiduciaries historically have believed. There is some data that shows that 401k participants are making some emotional investment decisions, pulling out the money, and have missed out on some of this unusually strong rise. And there's some numbers here that the newest update is not yet out, but where the average fund investor had about 4%, and the average return for the actual market was somewhere between 6 and 8. So if we take the average of that difference and call it 3% and multiply that by 20 years, without the accumulative effect, that's about a 60% difference, and that can make or break a lot of people's retirements. So encouraging and being disciplined, non-emotional investors is really valuable. Another interesting note, given that some people are sort of starry-eyed about some of these FANG stocks that have done so well, you really can't predict when a given stock will do well and when it can't. And some statistics here show that in the last 5 years, more than half of stocks actually lost money, whereas only 7% of stock mutual funds lost money. So the diversification effect really can matter quite a bit. This is the time of year we usually update our periodic table of returns as well. Won't go into this in detail, but you can just see that the colors are each represent a different asset class, and that there's no clear pattern. Sometimes it looks like there's a clear pattern. Large cap stocks here in blue, hovering in a range, and then boom, is up, or it could be far down. So that could happen at any time. Just a nice visual reminder of the importance of diversification and of not getting too excited about any given asset class at any given time, and remembering that asset classes that are sometimes out of favor come back into favor when you least expect it. The Cal and capital market projections just came out, and the return projections are down a bit, actually more than usual, about 55 basis points for US stocks, and about 70 or 95 basis points for bonds, which is significant, and that's 0.7 or 70 basis points on an inflation-adjusted basis after adjusting for this slight decrease in inflation projections. So this has interesting implications that we'll be talking about with clients, in particular those that are foundations and endowments that have spending policies that relate to inflation and projected returns. But basically, that biggest news there is the drop in the bond projections, given that rates dropped even lower than they had in the prior quarter in the prior year. So the farther rates fall, the more bond prices go up. But when bond rates start to go up, eventually that leads to volatility for bonds. Some new posts to our blog that, if you haven't seen, might be helpful to you. For example, an update on the new economic stimulation plan, including a summary of the PPP program, and what some aren't aware of is that, or may be aware that there is a more criteria of actually having losses during COVID to qualify, but what it appears is that it actually is in any given quarter, not for the whole year. So more businesses that are stretched and really need help to survive might be able to benefit than they think. So if that would be valuable for survival for your business and employees and help the employment numbers, something to look into. That program opened up about a week or so ago, and you probably want to get going and get in line so that you don't get a delay in consideration and funds. Then we have the rules and regulations reminders corner. Just run through a few things quickly here. They're updated IRS savings limits, but not a lot of changes there. A couple of general notes in terms of regulatory, given the change of administration in the White House. The Consumer Financial Protection Bureau, which had been in the process of getting stripped down and reduced, will likely increase in prominence again and in this new administration. And there were recent increases, and actually very recent notification about some of the final details around the ESG or environmental, social, and governance constraints for retirement plans that are subject to ERISA. And that is going to get a review, and it would be interesting to see if some of those constraints are relaxed just a little bit in the new administration, but we'll have to see about that. In terms of reporting, I won't go into the detail here, but a few weeks ago, the president barred investors from investing in certain Chinese companies, and that has led to a change in what's investable, and therefore some of the market indexes have changed their constituencies. So that also could change again in the new administration, so we'll see, but that has implications for both indexes and managers. A few elements here to take a peek at that I won't go into in terms of retirement plan updates. So if some of these things, if they're relevant to you, then please reach out to us. And then for foundations and endowments, again, as mentioned before, when given that the updated capital market projections are out, it's a good time of year to discuss with us the spending policy math adjustments and the related asset allocation implications of decisions. So we want to thank you, before we go into section 2, I want to thank you for always for your feedback. And we not only appreciate that, but thrive on that because we want to do the best we can to support you. If you know others that we can support like we've helped you, we always value those introductions and the opportunity to help others. So let's take a quick peek at some of the other charts. Here's the business cycle chart. We rotate these through every once in a while, or different ones each time, rather. And you can see what type of stocks or industries and sectors tend to do better in different environments. And in this recessionary environment, you can see what might tend to do a little better and where some of the managers may be emphasizing in some cases. Volatility has cooled down a little bit as of very recently after the COVID spike. And you can see that these the spikes here on this chart tend to tie back to more significant events in general. Unemployment has, as mentioned earlier, has come down and improved since the COVID spike, but is still hovering at above normal levels. So that is an important factor to watch as more and more small businesses continue to struggle, and we'll see how hopefully the stimulation funds will help offset that in time for actual consumer spending to pick up. Here you can see that consumer sentiment kind of bottomed out here not long ago and improved a little bit, but still below average. And those are some of the couple key numbers to look at. Federal debt, as mentioned, is up considerably and forecasted to increase further with what some may consider to be necessary spending, even if it increases the debt, to stave off a worse recession. The quality thermometer page here, we used to show a thumbs up or thumbs down, and hence the thermometer name. But this gives you a sense because some of the portfolios portfolios in general tend to have a quality bias that we build. And when markets are more speculative, higher quality, somewhat lower risk, stronger balance sheet, stronger cash flow, lower debt stocks tend to do worse. And so you can see here that those higher quality stocks have really trailed in the last year. Large value is an exception where large value stocks, higher quality stocks did do better there than their low quality brothers and sisters. In terms of cash flows in the industry, mutual funds give us a little bit of a sense of investor behavior as well. You can see there are actually outflows. This relates back to some of those 401k comments made a few moments ago, where some investors are getting nervous or pulled money out after the COVID crash and didn't put it back in, and more money has gone into cash. So yet the market still has been pushing forward. There's always this is usually a picture of future regret in terms of when there are significant cash flows, people chasing returns or out of more emotion-based decisions. In terms of valuations, you can see still with this market surprisingly strong valuations relative to history. So prices are more expensive than they have been of stocks, with the S&P and the S&P growth in particular being towards the top, but even value in some of the other stocks are doing well and high in terms of a price basis, which sometimes precedes some kind of cooling. This is on a 10-year number. Up here on the right is a 25-year number, still not at the very top of the range, but in the upper end of the range. So just want to manage expectations when things get like that. That can be followed by some kind of cooling. Not that you should take action on that. And then quick view of the 5-step process we use with all clients as part of the strategic planning and investment process. And for those that we meet in person, we can talk about this institutional investor behavior studies. There are a lot of individual investor behavior studies out there, but quite a few, surprisingly, that show that the average institution could use a little bit more discipline as well. Our clients have been considerably more disciplined than the average and have benefited from that. So with that, well, thank you for your time, and we'll take a peek here to see what questions might have popped up.